Good morning, hello, and welcome. My name's David Widmar. I'm an agricultural economist and the co-founder of Ag Economic Insights. It is my pleasure to be here today with you for the AEI BASF broadcast of the Economics of Agronomics Fungicide Use in 2020. It's been my pleasure to work with Dr. Josh Miller, help pulling this together. So I brought the economic lens of thinking. Josh has brought the agronomic lens of thinking, and I've learned a lot from Josh as we prepared for this. Josh, thanks for helping out with this. Tell us a little bit about yourself and your background with BASF.
Yeah, thanks, David. Like I said, my name is Josh Miller. I'm the technical market manager for plant health at BASF. And so I really get a chance to work with our fungicide products. Basically, right before we launch them, learn everything that we can about them, test them, evaluate them, and then get to support them through it and do things like this and hopefully provide some value to farmers. And started my career in ag retail in Pennsylvania. Believe it or not, we farm over in Pennsylvania still a little bit, and then continued education in Nebraska over there for a while. But happy to be here, and I learned a lot from you too. Learned some things that I think we intuitively were doing, but what the terms were around them, and you also challenged me to think about fungicides a little differently as well.
And the goal of today's conversation is to really provide you, we're going to spend 30 minutes providing our frameworks and our perspectives, and we've had to cut a lot out. We've unearthed a lot of things in our conversations, and we want to share with you 3 or 4 really key themes that we've captured. And the benefit here is we've sort of crossbred our thinking, and we're going to provide you with the hybrid vigor of what you can do and you can take to your operation. You can drill down. Now, I use some agronomic examples there, and I might have used them out of context, so forgive me, Josh, if I use those inappropriately, but we really wanted to bring you with some tools and some ideas that you could take to your operation to help you navigate that. And the backdrop for this conversation is that a lot of our plans and a lot of our expectations for what 2020 was going to shape up to be and how it was going to work out really fell apart here in March and in April in light of the COVID situation. A lot of uncertainty came into the situation. So now we have to make some adjustments into our growing season. And the first question we've been hearing a lot of is, does a fungicide application make sense now that we're looking at significantly lower corn and soybean prices? The second conversation we've been hearing a lot about and that we're going to talk about today is the crop insurance question. In light of revenues falling, we're getting closer to that crop insurance payout. And some producers have been saying, hey, maybe I should just manage this differently in light of a potential for a crop insurance payout. And the third part of our conversation, the first 30 minutes, is the boots in the field. Josh is going to help us dial in with some agronomic perspectives that we need to be considering in our fields here in 2020. And finally, throughout today's conversation, you can submit your Q&A. If you have to move your mouse around, but there's a Q&A box. You can click on that, type in your questions, submit it. You can do that at any time throughout the broadcast. We're going to save all those, and we're going to answer all those after we hit the 30-minute mark. Josh and I are going to stick around and answer any and all of your questions that you might have that comes this way. So this is a great opportunity for you to send in your questions as they come up through our presentation. So I'm going to kick today's off, and I wanted to share a table that I've been looking at quite a bit. And there's a lot of moving parts here. We're going to share a recording of this video so you can look at this chart in a lot of different detail in our follow-up email, this recording of this broadcast. But this is looking at corn, wheat, soybeans, cotton, and livestock products. We looked at different futures contracts, and we said, what were future prices in April 2019? What were they in January 2020 when we were making our budgets? And what were they in the beginning of April 2020? And as you can see over here to the right, things are quite a bit different in a lot of cases. Corn is down 11 to 13% compared to last year or just this beginning of the year. Soybeans down about 9% since we made those budget plans in January. If you start thinking about cotton, cotton has been hit really hard, about 24% lower than January. Live cattle, lean hog, and milk futures all down really hard. The one that has defied the trend, the one that has not followed this exactly, has been wheat. This July hard red winter wheat futures contract has only declined 3% since January, and actually up 11% from a year ago. So while everything has been pessimistic, we've had a pessimistic shift, we have to keep in mind that it's all relative across these commodities. And the situation for wheat isn't as dire as we've seen for some of these other crops. So when we think about this big commodity market shift, how do we go about responding to that? This has been a really challenging time of the year for this COVID situation to break out. The planters weren't rolling, but man, we were really close. I had a banker the other day reminding me, he said, David, you have to remember there are game time decisions, there are decisions we can make between the games, and there are decisions that we can make between the seasons. And that was really helpful, right? We don't want to fire the coach in the middle of a game. That is really a big shakeup to the team. And so we might want to wait. Maybe between the seasons, we might make those type of decisions. Sometimes you see in college sports, they fire them between the games, and that always grabs headlines. But I think the takeaway here for ag producers is to recognize I probably need to start making some decisions. I need to reevaluate where I am here in 2020, and we want to provide you some tools to help you approach these possible reevaluations, especially as it applies to fungicide. And we've had two big questions. The first big question is, again, as I mentioned earlier, does it pay, and what about crop insurance? So the first thing I want to talk about is, does it pay? As an economist, the ideal world here is that we have our financial records all up to date. We know our statement of cash flows. We know how our owner's equity is going to play out. And we can really approach the question of, should I apply fungicide in 2020 from a budgeting and economic perspective with the most current, most up-to-date records that we have on the operation. But the reality is we're just coming off the planting season. It takes time to get those records pulled together. It's not just as simple as opening an app and clicking refresh. It's hard to get our farm records all in one place, especially this time of the year. And so what we want to provide and talk about is a partial budgeting tool. This is a tool that allows us to isolate all the components of one particular issue we might be looking at. And if we take that isolation, we can start to look at how this decision in and of itself might impact the overall operation. So thinking about the fungicide question that we're framing up here is, we could say, what are the expected changes in revenue? What are the expected changes in cost? The difference between those two values are our net benefits. Now, I didn't share anything here that's groundbreaking. These are things that we all intuitively do, but I think it's helpful to remind ourselves of these simple tools. Our decision-making process is all about having a lot of tools in our toolbox and keeping them sharp. And so this is just a refresher of how this tool could be really helpful here in June 2020. When the net benefits are positive, we start to see an improvement in the economic situation on our farm. So maybe we're looking at a little bit of an economic loss, and we have a fungicide decision that has a positive benefit, it would close the gap between that break even and our break even costs and our expected revenue. And while we can use this for fungicide, we can use this for a lot of different aspects. We can use it in our livestock operations. We can use it in the question of, should we add more fertilizer late in the growing season? Should we have a second pass of herbicide applied here to clean up some lingering weed controls? Two things I want to add when we think about this partial budget is, we also have to step back and say, how confident am I about these expectations? And second is, how significant is the impact? On one hand, we want to be super confident and we want to have impacts that are very significant. But when they're not, we also need to step back and really do that gut check. On that net impacts being significant. Sometimes we want to wrap up like, oh, it has to have a really big net impact benefit before we pull the trigger. I also want to point out here that sometimes economics can't capture everything, and this partial budgeting tool could not answer all the questions. So let's look at a scenario here for 2020. What if we have a scenario where we're looking at some yield hit if we don't get this fungicide applied? And maybe if we do apply it, the net benefits are pretty small to our operation. Well, there could be some longer run impacts for our APH. Maybe we are able to raise our yields and lock in a yield number here in 2020 that could play out to our APH in the long run to the benefit. A second element here is maybe we're looking at using fungicide year in and year out. And if we know over 5 or 10 years, it's going to have a really big impact on our yields. Maybe it raises 3 or 4 bushels per acre. That can also change our risk management structure and that crop insurance tool because we have more coverage with a higher APH. So those are 2 caveats I want to throw out here with the partial budget. Now to roll up our sleeves a little bit and dive in a little bit to the 2 components. The first one we're going to talk about is changes and expected costs. And if you look at a budget or you sit around a coffee shop, you're going to hear a lot of producers say, "Oh, it's $20 to $30 an acre, or it's $10 to $15 an acre to put on this fungicide." And as an economist, I always find this peculiar when you hear a lot of different ranges, a wide range of costs. So we started digging into the component when Josh and I were preparing. And there's two levers here we have to think in mind. The first one is product cost. How much does a fungicide product actually cost? And we did some looking around, and for corn, you can see a range here from $10 to $20 an acre. For soybeans, you might see $7.50 to $20 an acre. For wheat, similar price range. So that's one moving aspect to this equation, is what product are we actually going to select. The second moving cost here, the moving target here, are application costs. So we have anywhere from $12 an acre maybe for custom hiring an aerial application to something closer to zero. And Josh put on his economic hat when we were preparing for this. And he said, wait, David, it can't be zero. And I said, well, it starts to approach zero as producers start to think about their cash flow and what their cash outlays are for applying it. So if we already have the labor is a fixed expense, we already have the depreciation or the payment on the sprayer built into our budgets. The only additional cost we have for covering these acres with our ground rig is perhaps just a little bit of fuel and a little bit of water. And that can start to seem like zero. And the point of bringing this out is if we talk to our neighbors and we talk to our friends or even some of our trusted agronomic advisors, we can start to see a wide range as to what someone says it costs to apply fungicide here in 2020. And cost is a huge part of this equation, of this net benefit equation. So our recommendation here is to start by creating a plan specific for your operation. Put a stake in the ground and say, if I apply this product in this manner, this is what I assume my costs are. And we could have a healthy debate as to how much of the application cost, if you have your own ground rig, you should include. But the important thing is to stick the stake in the ground and say, this is the number that I'm comfortable with. The second component is once you say this is the plan A or option A, then you can move on to these other alternatives and you can start to look at various deviations from this. So maybe a different product or a different application method. But the important thing is to know exactly what your costs are as you start to run and calculate this back of the envelope calculation for your operation. The second component here is expected revenue. The change in yield is a question for the fungicide. What sort of yield benefit am I going to see? And then we have to multiply that by an expected price. The expected price is the 10-ton elephant in the room here in 2020. When we have lower commodity prices, all of a sudden it starts to drag on this net benefit. And so, there's a lot of elements to this, right? What product did we use? How did the product perform? And what was the value of those additional bushels we captured? And a lot of eyes in 2020 have been focused on that commodity price element. But we also have to step back and remember all these other factors are important to keep in mind as well. We don't want to be hyper-focused on the expected price. The other component here that I want to set up, and then these are what I consider the hard questions for an economist to answer, and I'm going to kick it over to Josh, our agronomic expert. He's going to help us work through this. The first one that I think about as an economist is getting apples and apples lined up. If we talk about if we go talk to our agronomic partner and say, what's the benefit of me applying this product? And then we go off and we talk to another agronomic professional and we find a cheaper alternative. We can't say that's going to be the expected benefit that we heard about for the $20 product. So $10 solutions don't buy the benefits offered by a $20 solution. And that's really important to keep in mind as we move the levers around. We got to make sure we're comparing the benefits to the costs and we get that lined up. The second one is on average versus reality. It's really important to think about what are the benefits going to be. And sometimes there's benefits that we can capture on average, and sometimes we got to drill that down to what can I expect here in 2020. So Josh, I teed up some really tough questions. What can you share and what can you help us think about from your perspective?
Yeah, no, I think you did address that nicely, because one of the reasons we broke this into 3 different sessions was we understand that there's differences, especially on that second bullet point on average versus reality. But you guys also deal with a lot of diverse crops up there. And I think, honestly, we have a pretty good understanding in a lot of the northern geography about the different types of fungicides that may be used, the different modes of action, why it's important to rotate and mix, because sometimes you guys are dealing with crops that may get 6, 7, 8 applications. You start talking about sugar beets and potatoes and some of these ones that have sequential applications. But it's really important to keep in mind a fungicide is not just a fungicide, or all fungicides are not just the same. And so it is really important to understand what are the needs that you have in your operation for the crops that you're focused on. What is the disease spectrum that you're working with? What are the rotation partners that you have with chemistry? And so I think this is almost more important because there's more moving parts to it when we get into some of these crops in the north, to deal with that. And then with the on average versus reality. And if you can go to the next slide there, David, I think we bring this up because one of the things that we found, and I think in the north we're really in this bucket here, is that since 2005, about 90% of farmers have used a fungicide or tried a fungicide. But today that's only 40%. And so if we try to think about why, we can look at what that equation is up there, change in yield and expected price, but also the previous one where David talked about net benefit. Probably if you tried it before and are not using it today, for some reason you didn't see the net benefit that made you confident that you should use it again. And so why was that? Why do we miss those expectations that you didn't get what you saw? I think certainly one of those is the first bullet point there about the type of product that you may have been using. Having the value promise for one product but using a different product that maybe did not do that, that's certainly something to consider. But then the on average versus reality, if we go to the next one here, this is something I think is really, really important and something that we continually strive to get better at. But we often, especially in the world I live in with the manufacturers, we try to do enough research that we're confident to tell you what the product can do. But then we tell you what to expect out of these products. The confidence that we're telling you the right thing may not be certainly high, because I don't know when the last time was somebody's told you to have the second best product on the market. But it's also, how do we get data that's very local and relevant to you? And so this past season, we started the Rebex Fields Initiative. We placed over 1,200 on-farm trials, flew NDVI drone imagery, collected yield data from these fields, a third party validated it for us. And then most importantly, we made all the results publicly available on rebexfields.com. This was before we ever sold the product. We wanted to make sure that we had the confidence before we went into 2020 season, so you could look back and have that kind of confidence that I don't have to look on average how this product did, although we have averages. I can actually zoom into my backyard and see the trials that were done around me and how did they perform in my area. 2019, this was focused on corn and beans. 2020, we're continuing this on, and we're opening up the number of crops. We're going to do 10 different crops this year. And so this is something I think we need to consider. How do we look more at the reality of what fungicides can provide on your farm versus what the average is that we just all accept?
Yeah, it's a really important piece to keep in mind. So to wrap this piece up, we need to make sure we know specifically what's going on in our operation. We just don't want to take boilerplate information or coffee shop averages as we apply to our decision-making process, especially here in 2020. And when we have a diversity of fields and a diversity of crops, we really need to make sure that we have our expectations dialed in for what we're facing. The second thing I've seen a lot this year, especially on Twitter and social media, is some producers saying, hey, commodity prices have fallen so much, I'm in this sort of mode where I want to start to look at crop insurance, and I might not capture the benefit of mid-season management. decisions because I'm already in this crop insurance window. So I'm going to spend a little bit talking about what that is and how we should think about that more critically. So on the surface, the idea is that, hey, here's budgeted revenue. I have my APH times my spring price, and this is the total. The black line here tells me where my coverage level is. And so crop insurance provides me some dollar per acre coverage level. And the idea of this, I'm in the crop insurance window. I don't need to be thinking about mid-season management. I'm just going to sit back and let this crop coast through is here. The gray line says, hey, my revenue today is going to come in here. If I were to add a fungicide or a second pass of herbicide or maybe a mid or late season fertilizer application, I'm going to be able to bump my revenue, the revenue for the bushels I harvest, but I'm still in the crop insurance window. So I'm changing the balance of where the revenue is coming from, but my net revenue isn't going to actually change. And that impacts that equation we talked about earlier. We have the expected cost, but the dollars I'm actually going to see in my pocket don't change. It changes the source, but not the total dollars. So we want to spend a little bit of time in actually looking at the specifics of this. So I have an example here. Here's an APH of 45 bushels, spring price at 917. If we have an insurance coverage level of 80%, that's going to provide us $366 of crop insurance coverage. Right now, crop insurance here is around that 870 mark. So if we're still looking at an average APH of around 40, we're going to have to see commodity prices significantly retreat closer to that $8 or lower threshold before we start to see that crop insurance really pay in. On the other hand, if we start to see a yield hit, that starts to become maybe a little bit more advantageous. I guess to clarify, the matrix sees numbers here. Across the top is harvested yield. That fall price is there on the left. The matrix numbers are telling us what our potential crop insurance payout is. So if we see a number in the box that we're expecting, that would be that window that we were talking about. So let's change it a little bit. Let's look at the 70% coverage level, which might be a little more common for producers than the 80%, just for affordability. We can see that even at a 40 expected yield of 40 bushels per acre, we again need to see the crop insurance price for the fall quite a bit before we get into that window. Now, I also didn't include the right hand of the distribution, right? I started at 45 and lower. We still have higher yields, above trend yields that are possible. So this is a very, I guess this is an idea that's easy for our brains to attach to, but we really have to, again, put a pencil to paper and do the calculations for our operation before we jump with both feet into this management plan. So some things to keep in mind. The fall price window that I alluded to right now, we're around 870 for soybeans. For corn and soybeans, that isn't set until October. If you have questions about this, you should talk to your crop insurance advisors on all the nuances, especially for some of these other crops. The second one, our yields are still uncertain. We're still in the early part of this growing season. The third point, keep in mind that the price you sell for is different than the crop insurance price. This crop insurance price for the fall is going to be set in October. In a lot of cases, we're going to be marketing our grain and through the late parts of 2020 and the early parts of 2021. So you might be a little more optimistic about the price you can receive as you think about storing and your grain marketing activities. And finally, let's think about the longer term APH implications I mentioned earlier. Maybe you are in this window. So maybe you're at the threshold here where you're thinking, man, I'm close to this crop insurance window. If I add it, my net benefit's going to be pretty small, if not maybe zero. Well, if you go ahead and pursue this and you get that yield a little bit higher, that isn't a drag on your APH here in 2020. That could be beneficial. And again, I mentioned earlier, over the long term, maybe something like a fungicide application starts to build your APH over time. And that could be an advantage down the road as you start to see a higher APH and a more effective crop insurance tool for your risk management. So now I'm going to kick it over to Josh to talk a little bit about additional agronomic factors to consider here in 2020.
Yeah, thanks, David. These are just things like we already talked about. We can't really take things on average. We have to think about the reality of our situation. But these are some things to consider about how they're happening in maybe your neck of the woods. When we think about our planting or even yield potential, I bring this up, I could have shown the planting progress from the north and seen North Dakota lagging behind right now, but we also have spring wheat that's rated really good to excellent right now as well. So we have good yield potential in our wheat crop. Even when we think about corn, we may have potential there. Maybe not across everywhere, but the good crop that we have there, we may want to make sure that we get the most out of it just for those APH implications you talked about. I always think that it's important to look at the previous season as well. This geography was hit really hard with prevent plant acres, and what happened in those fields when we didn't plant anything. We often talk about the weed pressure that can build up because of no herbicide applications, things like that. The weed seed bank is growing there, and we'll visually see that happen as the weeds start to emerge. But the same thing can happen with diseases as well. That inoculum can build the residue, and so we still have that same thing potentially happen from the previous seasons. I mentioned disease pressure. Typically the north, depending on the crop, it can be a lower disease pressure area, but because of the diversity of crops that you grow, when we talk about sugar beets, you could have a really bad Cercospora leaf blight year. It's still something we have to manage every single year. Depending on where you are in the north, tar spot is becoming a big issue. And so really understand what the potential risk is of diseases in your area to make sure that it doesn't catch us off guard and really hamper us. And then as we get in the north, I think harvest concerns are certainly a thing to consider. When we talk about trying to get harvestability out of our crop, we have snow coming in early, we have winds coming in early. Standability is going to be critically important, especially in the north, and that's one of the primary reasons I've often talked to people in northern geographies, western geographies with high wind pressure, that they'll apply a fungicide. They understand that maybe it might just be a break even on the yield standpoint, but my efficiency that I was able to get through the field and not put as many separator hours on the combine, or that the crop just didn't fall down and I was able to get it out of the field. North Dakota gave us some great examples this past year where we were getting yields that were harvested in February. And man, did the benefits look good when that crop had to stand the whole way through the winter. So hopefully that doesn't happen, but just another example of things that we don't know what are going to happen, but things that you need to be thinking about and consideration.
Yeah, that's always helpful to keep in mind. We have to capture all the dollar values that we can capture, and then we have to step back and say, what might I be missing in this analysis that I just did? And so we have to consider all those factors. So to wrap up my part, I want to leave you with a little bit of thoughts, and then Josh is going to wrap up with some of his final thoughts. And then we're going to get to all the questions you've been submitting. So keep submitting those questions. You have a few more minutes to get those in. So to wrap up what we've talked about, I think it's incredibly important that we be very disciplined in how we approach the fungicide question for our farm. We have to know our expected costs, we have to know our expected benefits, and we have to know the environment in which we're making those decisions in. So that's what we talked about so far. The last piece I want to leave you with is the 60-40 rule. This is the total cost for raising corn and soybeans in Indiana. And if you were to take this and apply it to all the crops on your farm, all from sugar beets to winter wheat to spring wheat to corn to soybeans, you're going to see a very similar trend, the 60-40 rule. If you look at the right side of the pie chart, the blue area, fertilizer, seed, and pesticides, and the red pie slice, other variable costs, those are your total variable expenses. That's 40% of the pie. The rest of that pie are our fixed expenses, family labor, land, and machinery. And when we start thinking about making adjustments, either during the game or between the games and between the seasons, it's easy for us to get hyper-focused, especially as an economist, on the 40%, the fertilizer, the seed, the pesticide, the other variable. But it's really important that great managers step back and look at the whole pie, and they start to attack the entire pie. And in a lot of cases, it can be really hard for us to get a 5 or 10% edge on our peers when we think about being the low-cost producer in those variable cost categories. On the other hand, it's probably more difficult, but it's more likely that we can get a low-cost advantage if we start to look really carefully at family labor, land, and machinery. And one last thing I want to point out about the variable costs, so the worst thing we can do is if we start slashing our variable costs and stubbing our toe and start impacting yield. Because the quickest way to be a high cost producer on a dollar per bushel area is to hold back fertilizer or something that is linked to production, and we take our total cost per acre and we divide it by a smaller yield. And if we so we have to be hyper focused on those variable costs. So Josh, I went a little bit long there, but you're going to wrap up here and we're going to get to the Q&A. But go ahead and finish up with your final thoughts here.
Yeah, thanks, David. I was going to go into more about how do we make considerations and determinations of whether we're going to put a fungicide out there. And I think it actually ties into how we could potentially play the stock market sometimes, is our perception. And almost contrasting that with putting money into a 401k. And I actually have a real world example. I don't know if anybody knows what Peloton is, the company that makes these expensive, exercise bikes for indoor use. But I decided I wanted to try my hand at day trading. And I had this assumption based on what I thought were the economics of the situation and the situational analysis that after Christmas, people were going to be wanting to get off that holiday weight that they put on and spend some of that Christmas money on one of these new bikes. And so I bought some of the stock there on January 3rd. I held on to it for a little bit and saw that it wasn't doing what I thought it was going to do. And so decided to get out of it, there in February. What I didn't foresee happening was a global pandemic coming in and shutting down the entire world economy, which included gyms. And then all of a sudden, this product became in huge demand, and we saw this big increase. And so I want to put this there because we can kind of relate this to maybe a fungicide decision. We think that we understand the dynamics of what's going to happen, and we think it's going to be a good idea, but then something doesn't seem like it's going exactly that same way. In this case, commodity prices might be coming down, and you think, okay, well, this may not be a good decision. But that COVID event could be just around the corner, whether it's a severe disease outbreak, whether it's that harvest efficiency that you needed because of snow and the corn's going to stand longer because of other environmental concerns. But oftentimes by the time you realize that COVID event happened, you're already past the point where you could have taken advantage or even protected. And so I think it's important to turn our focus then, the next slide here, David, is to think about all the unknowns that are still out there. What is our yield potential? What's the disease pressure going to be? What are the growing seasons going to be? And switch that day trading mentality to the 401k mentality and say, you know what? I know that these products are going to work for me year in, year out. Oftentimes, it may be a really good net benefit, and there may be one or two of those years where it's a smaller net benefit, but on the long run, I don't have to play the market and guess, is it going to be the year to do it or not? Because oftentimes we may miss that. And so think about the benefits that we're going to get out of it, whether it's the yield or the non-yield benefits, like David talked about, the APH impact. We keep hitting on this standability, the harvest efficiency. There's a lot of other non-yield benefits out there, and that's where we would turn to thinking about maybe one of the BASF fungicides. I have two here just because I wanted to focus on the RevX Fields initiative we did last year. Obviously, we do a lot of research internally, and whether it's talking about Carumba in wheat, or Provosol in sugar beets, or Provosol in potatoes, or Preaxor in our pulse crops, there's a lot of data that we have in there, and we feel really good about it. This is an example where we're trying to turn the tides and get data from you guys to drive that. And so this is an example of a summary of the corn fields and the bean fields that we had out last year, looking at Veltima and Revitec, and you can see the consistency that we were seeing out of these products, the consistent performance, leading us more to the idea of we can use these products year in, year out, same with Headline and Preaxor, to have that 401k approach to make sure that we're continuing to drive benefit on our farms.
All right, well, thank you, Josh. That wraps up our 30-minute session. A lot of stuff, a lot of good ideas to think about and to apply to our operations. And I'm going to now introduce Jennifer Archer. She's also with BASF, and she's going to help us navigate the questions you've been submitting and sharing. And you still have, this is your last call for questions, so get in any last minute questions that you might have.
Thanks, David. So I think this one might be for you. We've had a couple around it, is just around cash flow. And what would you do if you've got limited cash flow in order to make some of these in-season decisions?
So I'll take the first stab at that. I think the first piece to keep in mind, specific for 2020, is a lot of vendors or manufacturers have credit options available. That's potentially a avenue to use that can be very helpful. It sort of ranges the spectrum from kind of a deferred pay, kind of an accounts payable situation, all to a short-term loan. So we can look into options like that. If we're going to pursue that, sometimes that also is beneficial with a marketing activity. So maybe we go ahead and market some of our grain. We did the calculations, and even though we don't want to market at the prices today, we were hoping for a rally, right? If it pays out at these price levels, it can be beneficial to take advantage of that. The second thing I want to add to that cash flow consideration is that one of the benefits of thinking about these season-to-season changes, especially for fungicide, is it would be a real, it's really challenging if we're in a scenario where we put in our budgets and our cash flows and we didn't leave a line item for fungicides. And we have a good crop going through and we've used up our working capital and we use up our budgeted cash flow. And all of a sudden we have a disease pressure that's coming in. And now we want to step in and make this decision about applying a fungicide. And so now we know that if we did the calculations on that partial budget, they're positive. We know there's going to be a biological response that's going to be really positive. And now our decisions being limited by cash flow consideration. And that can be really frustrating for producers. And so one of the things I think we also have to consider is if we are trying to guess the market, as Josh set up that example, we have to consider that sometimes that's a really hard proposition to be in. It's a really hard game to be in. So if we step back and we take a very strategic look at using fungicide and think about it from the year to year, year in and year out perspective, we can put a line item in the budget, we can plan for it in the cash flow, and then that gives us a whole lot more flexibility as we move through the growing season. So that's a bit of a long answer from the business side, but I think it's really important to consider how that cash flow plays out into our decision making. Josh, did you have anything to add to that?
Not a whole lot. I do think that it's important to consider, and you laid it out really perfectly. One of the things I know BASF is trying to focus on is make working for a farmer easier when it comes to purchasing chemicals and inputs and things like that, and trying to do away with a lot of programs and the cumbersome nature about figuring out what those costs actually are. But also what you mentioned, the financing piece. I mean, I know that's one of the things that we've really tried to work on in this year, with 0% financing for all fungicide purchases, through the no end point on that one when you purchase them, and then payment in December. So hopefully that is helping the farmers get revenue then at the end of the season before they even have to pay that off.
All right, thanks, Josh. Another question was around, we've heard something around 5-foot tall corn and Veltima. Are we spraying with 5 foot at 5 foot now? Is that your recommendation?
Yeah, that's a good question. So we are introducing a new expanded application window, and it will start at 5 foot. And the reason behind that is that when we started testing Veltima, we saw residual control on the important corn diseases that we were just trying to figure out when we could break it, and when would it run out on us. And so we kept going further and further back. And at 5 foot, we can still get through a crop. And we had enough leaf tissue out there, enough leaves that we could get adequate coverage. And so we're really confident in this application now. I think the way that this can really benefit farmers is those that haven't had access to the airplanes before. Agronomically, we still see that as I would say the premium application timing. When the corn's transitioning from the vegetative to reproductive stages, a lot of stress is happening at that time. We still normally see that at that time, but we know there's instances where that doesn't make sense, and farmers have just chosen not to use a fungicide instead of going with an airplane at that timing. And so I think this opens up an opportunity to use your own equipment, to have that operational efficiency to work into your budget. Maybe I wouldn't count as $0, as we mentioned earlier about application costs, but it's a place where you can save money, and also get out there for maybe potentially early diseases. Tar spot being one of them that continues to move across the north there for us. You got to hit that disease when and where it is. And so I'd say that is going to be a very good opportunity and option for farmers to expand their opportunity to have an impact on their crop.
What stage would you consider 5-foot tall corn to be?
It's right around that V10, V12 is what we're looking at. We know it's often hard to stage corn when it starts getting tall, and you got to slice the stalk open and count nodes and things like that. So normally that V10, V12 timing is when you get into the 5-foot.
Okay, and a couple around on a soybeans. Would you recommend an application at R1 given the lower disease environment?
Oh, this is a good one. So we still see the most benefit, consistent benefit between that R2 and R4 timing. R3 is that critical window when pods are starting to set, and that's when we really want to protect the crop. When we get into R1 conversations, and this is a good group to get into that with, is when we start talking about white mold. And white mold, if you've had white mold, if you have experience with it, if it's been in your field, you know it's not something you want to deal with year in, year out, because it can really cause devastating yield losses. And so you could consider multiple options, but I think there's one real clear plan of attack for this. And first, honestly, it comes to management. Knowing the fields that you've had a history of white mold in, those sclerotia actually survive for long periods of time, so those survival structures of that disease can be living in your soil for a very long time. Plant varieties, soybean varieties that are more resistant, more tolerant to white mold. Don't plant susceptible varieties there. Look at your row spacing, continue to increase row spacing to keep the airflow moving through the canopy and reduce the disease pressure there. But then fungicides can come into play. And this is where I really do want to make a point here, because there's, I think, a lot of confusion in the industry right now around white mold, and claims are out there right now. There's certain fungicides out there that can suppress the disease and could keep it somewhat in check if they're in low levels, and Preaxor and Rebitec would fall into that, but so does Delaro and Mirabis Neo and some of these other fungicides as well. We don't recommend that when white mold's there, because if white mold is there, none of those products listed are going to be good enough to help you get past that issue. Endura fungicide is the one product that really does take control of that disease. It's the one that's recommended by pathologists at universities to really hammer this if that is an issue. And so it does require an extra application, a specific application for white mold if you have it and it's with Endura at R1. It's not the cheapest application, but when we look at net benefit, if you're expecting to have it, if you've checked off all the buckets that make you susceptible for it, and even use the Sporecaster app that I think University of Wisconsin has put out, it really helps you get more information about whether you're at risk. It is a product that can be beneficial. And then you would come back with the Preaxor or the Rebitec to really help finish it out, plant health, and clean up any additional disease infections there. And so, sorry that was really long-winded, but I think this does require clarification, because I hear a lot about this same question. I get asked it all the time about how do I control white mold? Can I just put anything down at R1? And the answer to that is an absolute hard no. It does require that specific application.
All right, thanks. And then this might be the last one unless any new questions come in. But what is a realistic ROI to expect from an input like a fungicide or fertilizer?
David, I don't know if you want to jump in on this, and then I can also weigh in.
Yeah, so ROI, return on investment, and I always find that to be a hard thing to think about, because on one hand, I want to think, as long as if I know the benefits are positive, right, I should keep adding them as long as they're positive. But at the same time, there's uncertainties. And so we got to think about those uncertainties about what I need to tackle. And so the way I would frame this is, I would think, if I'm going to apply this, because the reason why we think about ROI is because of the uncertainty. So I think about, what's a potential outcome in a low disease year? And what's a potential outcome in a high disease year? And if the product you're going to be using doesn't provide you coverage in one of those areas, you really need to be thinking about that ROI, and that's usually how we start thinking about betting markets and how big of a return do I need to get to offset that risk. So that's one way of looking at it. If you're able to find a scenario in the part of you're in a region of the country, or you're in a part of the you have factors like Josh mentioned with the white mold, you might look at this and you might say, this isn't really this isn't necessarily an ROI conversation. This is just looking across. I can get protection in low yield, low pressure years and high pressure years, and this is probably a good strategy for me to pursue. I just want to say that, again, I think sometimes this ROI comes from this idea, maybe older fungicide technology. And in preparing for this, it really illuminated my thinking is that fungicides are not a commodity. And so I think it's a sort of a legacy way of thinking about these, that some years you put it out there every year, some years it pays and some years it doesn't. That's sort of a legacy idea. But we also need to look for opportunities where we can actually see year in and year out benefits. And I think that gets back to this 401k idea. We want to find solutions that pay in and year out.
Yeah, I would agree with that. Like you said, when you think about ROI, you're trying to take an average idea, on average idea versus a reality idea. And so you need to really think about the scenarios that you have year in and year out, and what is the right product for those scenarios. David mentioned working through like the different disease environments, and we actually did this exercise on all the data we have on a few different products, ones that we would, our products, and then ones that we would consider other premium products, and then ones that we would consider those maybe discount products. And we found some interesting things when we looked at the probability of a yield response. We saw consistency across some BASF products there, where it was low, medium, or high disease. We still saw a response, a yield response, and a net benefit. Whereas some of the other premium products, you got that net benefit when the disease pressure was really high, but you had a negative net benefit when it was low. And then it just flipped when you looked at some of those more discount products. You got a positive net benefit when the disease pressure was low, but you had a negative net benefit when the disease pressure was high. I know that sounds confusing, but basically it was showing that you really need to figure out what your scenario is and then pick the product that's going to work for your individual scenario. And especially, we keep talking about Revitech in a lot of the world right now, but Preaxor has been that proven performer across a number of crops that you guys deal with in your geographies, with the consistency that year in, year out is paying. And that's the product that I think a lot of people have really grabbed onto. And so that's, it would just be an ask from me to you to try that product out on your farms as well and see if that can provide you some of those consistent responses.
I'm just going to jump right back in there. And one more thing. ROI is a really helpful tool for comparing alternatives. And so ROI allows us to say, here's the cost of option one, here's the expected benefit, here's my net impact, this is the ROI here. And then here's alternative two, and here's the ROI. ROI is not necessarily a good tool for this to fungicide or not to fungicide decision, right? This is where we talk about these net benefits. So then to follow that one step farther, an ROI or net impact of 0 still might be, or maybe slightly negative. You still might say, I'm going to go ahead and pull the trigger on this because I know there are non-yield benefits that I still put value on. So if you know you have a tight harvest window, if you know that you have a variety that might be a little susceptible to harvestability issues, or you are looking to make sure you have high quality because maybe you have a contract that says you need to get the quality in there. I could keep talking about non-yield benefits all day, but my point is that we shouldn't become hyper-focused on a specific ROI threshold that we need to clear before we make these decisions. We just need to do the calculations, use the ROI to make comparisons between alternatives, and then also consider the non-yield, non-revenue impacts as we go ahead and look through that final yes or no decision.
Good point.
All right, thank you both. I think that's all the questions we had.
All right, well, thank you all for joining us. A special thank you to BASF, Dr. Josh Miller and Jennifer Archer for helping in today's presentation, but also making this event possible. To wrap up, I want to wish you all the best of luck here in 2020 and hope to see you down the road in future events or in future webinars we might be putting on. So thank you so much. We'll see you next time.
Thank you.